Good evening, everybody. Darin Davis here with Presario Ventures. I've also got with me Allyson Silver, who's the Senior Director of Investments. Allison's been with us almost 5 years now. As most of you guys know, my business partner and I, Tom Burns, we started this business almost 10 years ago. And in the whole thing, when we got started, was Tom's and I both agree that education is a big part of what we do. And pre-COVID, we used to have a series called GBB, or Good, Better, Best. And every quarter we would have a meeting at our offices in person. And it was really driven, the content was driven by the investors and the people that wanted to learn more about investing in multifamily. But with COVID, that kind of slowed down quite a bit. And so we're kicking it back up. And I'm sure going forward, we're going to be doing a lot of these online. But this one is, the deal is in the details. And why we chose this is because the questions that you guys were asking us about how do we do deals, how do we evaluate deals, how did we pick this deal over another one, how we do what we do. And so we're going to spend the next 20, 25 minutes sharing with you what we look at, how we analyze, how we view these deals, and when we actually make a decision to do one of these opportunities for an investment for you, for you and us. The other thing I want to mention is that some of you guys that have been with us for 5+ years, you probably saw that we did more acquisitions, but you're seeing us now do more development. There's a reason behind that, and we'll get into that in a little bit. But we have pivoted to go more into the development, and we'll talk about that a little bit as we go through some of the analysis and we look at the deal and the details. So I'm going to turn it over to Allyson. She's going to do the lion's share of the presentation, and we'll kick it off.
Great. Thanks, Darin. So here we are. I'll talk to you a little bit about Presario Ventures in more detail for those of you who are new investors and haven't been with us for a little while. So we are an Austin-based private equity firm, and we focus on investing in ground-up new multifamily construction and newly constructed assets. And what you see here on the screen is a few of our recent projects currently within our portfolio. And I'll highlight a few of them. On the top right corner, the large picture you see is the current apartments located in New Braunfels, Texas. And the top left, you can see the Vista at Razor Ranch. This is an active adult community located in the Denton town of North Texas. We have ventured into the build to rent space. You can see some of those products as well. And in the lower right hand corner is the Retreat at North Bluff, our legacy asset. So if any of you are longtime investors, you're very familiar with this one.
That was our first. That's where we started the company.
And so I'll go into the top 5 things that we evaluate whenever we underwrite a project. But first, I want to highlight a little bit about Presario and how we fit within a project. So I mentioned that we're a private equity firm, and so we are composed of, our investors. You are the core of our business, and which is why we are here tonight speaking with you. But we participate as common equity in the capitalization of an investment. We can co-sponsor the debt, we can co-develop projects, but we are traditionally the equity partners, and we provide typically 80 to 90% of equity for any transaction. So that being said, one of the most critical components that we underwrite and evaluate is the team. Who are we partnering with on the deal, and what do they bring to the table? So our developer and GC are some of the most important components, and we need to understand, what is their track record? Do they have experience within the industry, within this product type and asset class? Have they done full cycle projects? And what is their reputation? So we spend time evaluating, via online resources, via background checks, what is their experience said about them, and just making sure that they're a solid group, because we're going to be in business with them for 5 years, sometimes longer.
Yeah, something I want to point out here is that we really try to work in the DFW area. We try to work with developers that are specific to that area and general contractors, because of the subs they have in that area. Same in the Austin Metro, San Antonio Metro, Houston Metro. So we really look for strong regional developers and general contractors. And quite frankly, that plays into property management as well.
It does. So property management is a really critical component. It's a little competitive in our business because we utilize third-party property management. And so we're evaluating, who has the best presence in this market. Do they have experience with assets of similar type in construction, and what advantages can they bring? So they'll be helping us with our underwriting to kind of prove up some assumptions, which we'll get into in a little bit more detail. But having a management company with a strong corporate foundation and on-site presence is really important, because the management staff you have on site, they're running your property day to day, they're your reputation management. So we're actually involved with all of our management interviews to make sure that we feel like we have a solid staff on property. Yeah,
and something I do want to point out, we get this question quite a bit, are you developers? And I want to tell you, we are private equity. We are primarily, as Allyson mentioned, common equity or limited partners. That's our focus. I mean, we are laser focused in that, and we're really. And don't get us wrong. Do we oversee the developer? Absolutely. Do we oversee the GC, the property manager, the lender? Absolutely. We're actively involved. We're just not that entire team. We actually try to pick the best in each group, pull the team together, and then execute on the project.
Right. And as far as the lender's concerned, I think, it's important to understand how relationship driven this component is, because your lender, is the one that's taking your project. You're working with them before the project closes all the way through closing. So the processing of that, the speed of the transaction time frame, even throughout the process as you kind of reach certain milestones with your development. And, making sure that they're really proactive is really important with us. We've kind of experienced both fronts, with some less proactive and more proactive lenders, some of which have some greater pull within the agencies or HUD, and, having those is really important to the success of your deal.
Yeah. And I'll just point out something in this picture here. You have 4 different groups being represented. You have the architect, the developer, the general contractor, and the equity. The only person not in that picture is the debt, which on this project was HUD. Correct? Okay, HUD sponsored debt. Yeah. So, but you can see that's the team. That's what it's going to look like on almost every project we do.
Right. So location is very important. This is one of the things that Presario uses internally to kind of weed out which projects we focus on and which kind of pass the next threshold that we evaluate. As you can tell here, this is an example of our portfolio, and most of our projects are located within Texas, right along I-35, and you can see that they're in the secondary peripheral markets that are supported by the major metros, that's supported by all the jobs and the infrastructure of those major metros. So if it doesn't kind of pass some of those initial tests, we typically will kind of move on. That being said, we do explore projects outside of Texas and outside of these markets if they meet some certain criteria. Those criteria would be whether or not they're a known developer partner, if we've done business with them, we have experience with them, and they have experience in this new market, and the market has some of the similar economic trends and demographic positive trends, then we'll take a look at it. So you might see some of those coming up in the next few years or next few investment opportunities, but for the most part, this is kind of down the fairway of the type of projects that you'll see.
Correct. Yeah. The one thing I will mention is to Allison's point, you're going to see anywhere where there's a friendly business climate, there is I think it's tax advantaged for us. And there's jobs, and those are your typical, Texas, Florida, the Carolinas, Georgia, Tennessee, Colorado, Utah. All of those areas are very friendly to what we're trying to do with a multifamily and for the investor.
Right. And so once we narrow down on the project specifics, we're going to take a really deep dive into the demographics and the economics of this submarket and what's going on around this area. So, we're going to be looking at what the income levels are. We're going to be looking at what the population and job growth has been. we're going to evaluate, what's the road visibility, because I think that's really important. Despite the online presence that we have, you're always going to be having road visibility, and what's the traffic count going to be driving by. We're going to be looking at what the job growth is and what the distance is to employers, who are the major employers, and also what the distance is to your schools and to your grocery stores. So we spend a lot of time evaluating that online. We utilize third-party resources, and some of those resources specifically help us indicate the supply and demand. A lot of times, typically most every deal, we will engage a third-party market study that does a really thorough analysis of the supply of oncoming projects and the current demand based on households and the total renters within that market. And so that really allows us to feel comfortable whether or not, throughout this development cycle, if there's going to be this demand for the type of housing that we want to construct.
Yeah. And one other thing I'd like to say on supply and demand that's really important, when we engage these third-party market analysis, market studies. We scrutinize those, and they're 100 pages, but they tell us everything from income to age to education. It's really thorough, and we can project anywhere from 2 to 4 years out and be pretty consistent. And we've been doing this for 10 years now, and every one of those market studies has been almost spot on. That we've watched the trends that they've presented to us, and absolutely what's in the pipeline, what's already been delivered, what's the new population look like. So it's been very helpful, and we use those quite a bit, right, to make our decisions.
We also utilize our relationships. That's our brokers that are knowledgeable within the industry, right? So they're going to tell us, what they know, that, whether or not it's included in that market study. Maybe they've heard something else. If this submarket's going to have 500 to 900 units coming online and planned projects or permits submitted or in the early stages of planning, we'd like to know, where do we fit in with that time frame, and what is the demand. A good example there is our project in Lockhart that we recently sold. One of the most attractive things about that project was there was no new supply within the past 10 years. So that we knew from the get-go that there was pent-up demand, and we saw that reflected in the leasing activity, whereas we leased up in 4 months because there was so much demand. So having all those factors understood from the beginning is going to be help your project be very successful.
Right.
So probably the most asked question we get recently is all about project cost and budget, and rightfully so. I'm sure as most of you have been following, within the news and within the industry, of course, construction costs have gone up over, the past year, 18 months or so. And we definitely have seen that reflected. So we are accounting for that by working closely with our developers and working closely with our general contractors to ensure that we're getting hard bids before we proceed with the project. And, these costs are going to vary across the product type, whether or not you're going to be building your suburban wrap style project, like you see here shown on the screen, whether or not you're going to be building a parking garage, structured parking, or do surface parked. All of these are factors that kind of go into what can be supported within the market. One of the other factors that kind of, it's all a puzzle piece, right? So what's supported by the rents are the increased project costs supported by rents. And we actually have seen that with a lot of our recent projects. While construction costs have gone up, so have the rental rates and the rent growth in these suburban markets, as you see the demographics flowing from, the core markets to these suburban areas, looking for space, looking to kind of exit into these peripheral markets. It's supported. So you have to weigh both of those items, to make sure that it's supported by the project.
Yeah, and two things I want to point out here. One is in our market, I'm going to say Texas. We're very fortunate, and we already had a shortage of housing pre-COVID. COVID came in, and it just made that worse. Okay, so we're still playing catch up, and we will for another decade. The key areas that we're talking about, the major metros and the secondary markets, there's 10 years of demand, just kind of, statewide in those major markets. The other thing, and it's kind of one of the most obvious questions we get, is, well, if the supply chain's messed up and supply and materials are can't be found and labor can't be found, how are you guys doing this? And quite frankly, guys, I will tell you this: if capital wasn't as cheap as it was today, we wouldn't be doing it. I'll tell you that right now. Capital is incredibly cheap compared to, and there's an abundance of capital out there. Something like I haven't seen, and I say we've been doing this 10, 11 years, but I've been in kind of investments and finance for 20 years. This is like something I've never seen before. So, the amount of money and the cost of money is very advantageous and favorable for us.
Right. And I will say on the flip side, it's been a seller's market for the past few months. We've taken advantage of that. So not only is the cost of capital inexpensive, you still have very attractive sales valuations and pricing. So, it's all kind of, flowing together and making sense, but we're going to be very conscientious of what our business plan and investment strategy is to make sure that, it all works together. I'll highlight a little bit about land costs. Land is a hot commodity. Of course, we have a lot of it within Texas, but, making sure that you have the right parcel of land is very important. There's some hidden costs within some of the land that you might not be aware of, and you just need to make sure you do your diligence to understand what are the municipality fees? Are the utilities access to the site, or is that something you need to install? What are the park and impact fees going to be? Is the city going to require you to install some roads? That's going to be an extra cost to your project. So just making sure that all of that is accounted for, in addition to just, looking at a piece of dirt on a price per square foot or a price per unit basis will really impact your bottom line.
Good.
So the cost of capital, Darin touched on a little bit. I'll just expand on that by saying we spend a lot of diligence structuring our capitalization based on our investment thesis and our investment strategy. So, if we're going to be looking at a development, which is more of a merchant build, which is typically held within the, 3 to 4 year time frame, constructed, leased up, stabilized, and sold, we're going to structure our capital stack a little bit different with the type of debt and equity than we might structure on a longer term hold. So, if we're looking at this on a 10-year hold, it might make sense to put some higher leverage debt on it. What you don't want to have is maybe a pref equity with a really high interest rate on a longer term hold. So there's a lot of different ways to structure your capitalization stack, and that's something as the equity we are very attuned to and spend a lot of attention structuring.
Yeah, exactly. I mean, the net of this is there's 10 different variables of capital, and we'll pick the best 2 or 3 as we build this capital stack to make sure we're maximizing returns. So it's not just a one size fits all.
Right. So the Performa, kind of the bulk of our underwriting, and I want to start off by saying, when we're evaluating a deal as the equity, we are presented with a model. So our developers already underwritten it, and our lenders typically probably already underwritten it as well. And what we do is we re-underwrite it. So we're using our assumptions, and we're going to prove up, what they think that they can achieve. So, I'm not going to go into all the specific details of what you see here. This is just an example of a pro forma from a recent project. But what I will talk about is one of the advantages of new development is that we can tailor our project design to the product type. So we can, be involved in establishing what is the unit mix, what does the market require, or what's in demand essentially. So if there's not many 1-bedrooms or efficiencies, well, maybe that's an opportunity to take advantage of that and add some lower price points to help capture some of those renters at that lower price point. Or maybe you want to tailor the project to some townhomes, larger units that can accommodate some families. So we can account for all of that when you get into a project in an earlier stage. Of course, that's going to be supported by what's in the market today. When we look at rental rates and revenue, this is something that we err on the conservative side of, and we're going to be boots on the ground. We're always going to go shop the comps, even in person, and understand, what is this neighboring property able to charge and achieve, and what is their vacancy? What are the concessions they're offering? You'll find a lot of developers or sponsors will underwrite what's called trended rents. So they're going to be, you know, underwriting to what they think that they can achieve in 15 months from now, or, you know, even day one once they acquire a project. And what we like to do is make sure they're supported by today's market. So we're going to make sure that, you know, what is achievable today. And while we definitely are going to account for some rent growth, you know, to make sure that's achievable in today's market really helps set the stage and outperform the pro forma. Some of the other income and expenses, of course, you can verify, you know, what the competitors are charging for carports or garages. Your property management company is going to be your most useful resource in this regard, because again, we like to utilize people that have presence within the market and are familiar with kind of how these operate and what's commonplace within that submarket. Some of the expenses, I won't get into all these details because there is kind of a methodology on traditional price per units on what you can underwrite to. But we get this vetted by our property management company. Again, you know, when a developer is presenting an underwriting to us, we're going to re-underwrite it. And so, you know, if we think they're a little too conservative on payroll, knowing that we want this type of staff at the property, we're going to bump that up a little bit. Some of the uncontrollable expenses that are noteworthy, we get these common questions, specifically regarding insurance costs. I will tell you, insurance costs have skyrocketed over the past 2 years, essentially. So we've accounted for that. It's basically after Hurricane Harvey and all the aftermath, you know, insurance carriers have hit the multifamily industry really hard. We've seen inflation across our full portfolio. And so we're now accounting for that, you know, making sure that we have those costs a lot higher than we used to underwrite to. Real estate taxes, probably your biggest variable of all. Again, we always like to err on the most conservative side. So we will utilize our resources. We're going to utilize tax consultants. We're going to utilize comparable properties and what they're being charged on a price per unit basis and so forth. One of the advantages that we have in these secondary markets is you're traditionally working with smaller counties. These counties are more favorable for business. They're going to be a little bit less aggressive on the tax rates and reassessment rates than some of your major metros.
Very true. And we also use a third-party service to help validate. And if we feel the taxes are too high, they'll contest them. And most of the time we get a favorable result.
Right.
So this is the area on the investment return metrics. And I think this is really important to understand kind of how we look at this from top to bottom. But first I want to say to everybody on the call, investors and non-investors, when Tom and I started this company, you know, we always said, we've got to make our investors first. Whatever we do, we have to take care of them because it will come back in multiples to us, you know, if we do that. So, you know, every time we look at a project, we look at it, would we invest in it as a limited partner? Would we invest in that area, in that type of product? And would we expect that type of return to be a good return? And I can tell you still to this day, when we're underwriting a project, you know, the first thing we do is go to the very bottom of the page and say, what do our investors make? And then we start working backwards and saying, can we work ourselves into this deal and still be profitable as a company? So I just wanted to share that with you. That may be the norm for most people. I don't know that it is or isn't, but it's because of you guys that we have this company and can bring you these opportunities. The second thing, that a lot of the questions we get, especially from first and second time investors, people that have just met us, you know, how do you guys evaluate the returns to the investors? And there's really two key ones. One's called an IRR and the other one's a multiple. Now, personally, I like the multiple because to me, it's more favorable. It's more consistent. And it's something that I'm looking for as an individual if I was a limited partner. And all that is that if I tell you that we're doing a 1.6 multiple on this project around year 3 or 4, that means if you put 100,000 in, by the end of this transaction, you'll be looking at $160,000 return to you. As simple as that. I like that because I know the money I put in and what we're targeting. And I can say for the most part, we have far exceeded that number on all of our deals, but we do, to Allison's point, we do err on the side of being very conservative. The IRR, some people like that. You really see that with more institutional groups, and I'll call it professional money, where they have deal after deal lined up, one after another, one after another. And an IRR is just simply the speed of money. How fast is it in and out, and what kind of return it makes. So, you know, in the retail side, kind of you and I, it's the multiples what I kind of favor. In a more institutional side, it's the IRR. But some people on the retail side do like to look at the IRR as well. So, and then the third bullet point there is, you know, the target returns. And as we've mentioned, you know, we have pivoted to more development transactions. So with that, the developers are that they develop. They don't develop and hold long term. They develop and sell and develop and sell and develop and sell. So we're looking at projects lasting between 3 and 4 years. You're looking at the multiple about 1.6 to 1.4, and that IRR 15 to 18. And I can tell you now that the last 5 projects we've done have all underwritten to about those terms, almost identical. So when you see a deal from us, there'd be some little variables. I don't think it would really be anything lower. It may be slightly higher, but you're going to see about that same metric on every deal we present to you. And if it's any different, we'll absolutely raise the flag and say, hey, look at this one a little more closely, because this is one that we think is going to do better. But that's what we underwrite to, and those are the type of deals we're looking for.
Yes, and that's a great segue into presenting the next opportunity we will be launching in the next few weeks.
Yeah. So, guys, this one has not been final, but it's close to final. But we're very confident to at least introduce it to you. It's a project in Kyle, Texas, and for you guys that are not familiar with the Austin Metro, this is the next town just south of Austin. So, you know, from downtown Austin, I think it's 8 or 9 miles. So it's right on I-35, which is our major corridor, north-south through Texas. It's a 262 unit, and this is what they call kind of a Gerben, which is garden style and urban. It's a really nice looking product. It's almost identical to what we did in New Braunfels, the one that we just completed. But if you look at this product, I mean, just from the pool and the style of it, it looks more big city, even though it's in the suburbs of Austin on Kyle. And if you look at the investor metrics, and it's right there where we think most of our deals are going to land. We're looking at a 17 IRR, a 1.65 multiple, and we're looking at that 3 to 4 year time frame. And this project, you know, is a very attractive project. It's got a well-vetted GC firm, a well-vetted development firm, and a well-vetted architect firm that are on it. And then we're bringing in, I think, 85 or 90% of the equity into this project. I think closer to 90% of the equity into this project.
Yes. So what we'll do now is wrap up our webinar and open up the availability for you to ask some questions. We'll stay with you for a few more minutes, and feel free to type in your questions through your Zoom meeting link, and we will address them as we see them. Thank you so much for joining us.
Yes, thank you, everybody. I really appreciate you spending the last 20, 25 minutes with us. So let's pull the questions down.
Great, here we go. Okay.
Okay. First question that we have, what is the typical minimum investment? So what we have typically done is we say $100,000 per investor. First-time investors who don't know us, we've actually put that down to $50,000. So that gives you a chance to come in on one of our deals. But after that first one, we lean pretty heavy to keeping it at $100,000 as our minimum.
Right. We've had someone ask, are there different class shares for the project in Kyle?
In Kyle, there's not like an A class and a B class. The only thing that there is on this one is that you have limited partners and general partners. So you'll have 2 different groups of investors, but you won't have a limited partner A, B, or C getting a different return. It's all of us are the same.
Right.
So,
and how soon will this be available for investment?
The Verge, I think, you guys, is going to be available the 4th week of November. That we'll be wrapping up our agreements, and we should be putting this out the 1st or 2nd week of December to fund sometime in the 2nd, 3rd, and 4th week of December, right through Christmas. I keep saying every year I'm not going to work through Christmas, and every year we're funding something at Christmas all the year in. So
great way to end the year.
Yes, always,
Yeah.
always.
We've had someone ask if our business plan is to develop, lease up, and sell, or do we keep it for long-term cash flow?
That's a very good one. So I'm going to share with you personally, I'm a cash flow guy, but the market is not dictating that. What with the cost of money being so cheap and cap rates being so low, and as Allyson said earlier, this being a seller's market, it makes all the sense in the world to build it, lease it, and sell it. Are we looking for some long-term cash flow deals? Yes, we are. We just haven't found one in the last 2 years. It made sense for us to hold on to and sell because I'll give you an example. One of the projects that we're selling it today for what we pro forma it in year 7. Okay. So we're getting 7 years of money in year 3 instead of waiting for that 7 years. So it just makes financial sense to sell that. But we're always looking for cash flow, always. So
I'll take this one. We have a question regarding the IRR and whether it's an annualized number. So not exactly. The IRR is all about the timing of cash inflow and outflow. And when we're doing our financial pro forma, we actually use the Excel function XIRR, which accounts for the dates upon which you get distributions, your money is inflow, the inflow of capital, and then any distributions in the sales. And so it's important to note that most of our development projects are going to be backloaded, right? Because a lot of the time upon which, you're constructing the asset, you're not going to have cash flow, and a bulk of your return is going to happen at the sale.
Yeah. So I like this next question because I've gone through this before, and it's about interest rates. I remember 2008, 9, and 10 when the market was in trouble. And interest rates and capital, it was a mess. But here's what I can tell you. If we come out of this in 3 years and interest rates are up and somebody's putting permanent debt on it from the construction debt, that will affect our price. There's no doubt about it. If we were doing this today. So if interest rates went from 3 to 4 or 3 to 4.5 or something. However, I'll let you kind of talk about the sensitivity in the underwriting model and how we kind of vary that. So we kind of look for worst case scenarios, and they're pretty bad, but go ahead.
Absolutely. So our model is really dynamic. We've spent a lot of time developing a really robust investment model. So it allows us to input a multitude of variable scenarios. So it's everything from the timing of a lease up, whether or not it's 20 units a month or it's 8 units a month and how long that takes. Whether or not the rental rates can fluctuate. If we're going to underwrite, say, $1.40 a square foot, maybe they're $1.35, maybe they're $1.20, maybe they're $1.80. All of that impacts through the returns and through the model. What are the vacancy percentages? And it's not just about physical vacancy, it's about concessions and your loss to lease. All of these factors, including your interest rates and the timing of your loans. I mean, we easily manipulate, and we always are underwriting to all of these different scenarios, asking what if this happens, what if this happens, and how does that impact the returns?
Yeah, and the last thing I would say on this, and why I got into real estate 21 years ago, if it underperforms for a few years, you still have that hard asset, and I've never, and we and I have never had to just lost a deal. Some of them didn't produce as much cash as we had performed because of some downtimes, 8, 9, and 10. But then we've had some like today that are just blowing it out of the water, but we've always kept the asset.
Yeah. We've been asked about the GP and LP splits.
Yeah. This is really interesting question because there's about 10 different answers. So it's it's like an attorney speaking. It depends. And I hate that when everybody says it depends. But the thing is I will tell you this, that the better we perform, and there's a waterfall to that, like the faster that we can get you your return, the bigger the split goes to the GP. Okay. So you'll see a typical, what's our typical that we'll do? 80, hang on.
I mean, so we're always structuring to the investor returns first. I would say we typically at a preferred return to the investor at the asset level, and the splits down to the Presario level can vary depending on how we are invested in the project. On some of the projects where we are co-developers and part of the co-GP structure, we might have a little bit larger promote. And that is all waterfall based, as Darin mentioned. On some projects where we're participating just strictly as common LP equity, then we just have a nominal promote of about 20% at the LP level. And it's really the developer and GC that are performance-based compensated by their promote. So it does depend. I mean, in each project we, you know, whenever we do, I'll tell you this, whenever we do a new investment, we always provide an equity book and a description of that waterfall, so you can see how we're compensated.
Yeah, and let me address that waterfall question. And what I'm going to say on the waterfall is that the better we perform for you, the more that we make. And if we could afterwards, I'd like to have a phone call with you and give you a couple of structures, because it would be really hard for me to explain a waterfall on a video conference here. But I will answer that question directly. So if you want to give our office a call tomorrow, I'd absolutely grab some time and share with you what we do.
Sure. I'll share. We have a question about the track record of the last few projects' performance. We have recently sold a newly constructed asset, and we were in the process of finalizing all the last financial numbers. But essentially, on the investor level, we are returning 25 to 27% IRR and a 2.25, 2.26 multiple, and that's on a 3-year hold. So as you can tell, those return metrics exceed what we're projecting here. It is a good indicator of how they typically perform now.
Yeah. And then we've got another question, and then I think we're going to wrap it up here in about 2 minutes, about, you know, holding an asset and then, or, you know, flipping it or holding it for cash flow. And guys, I can tell you this, if the market were even close to something that I thought we could hold and be fiscally responsible to our company, our employees, our investors, everybody, we evaluate it that way. And sometimes it just makes sense to take money off the table. And when we do take that money off the table, it allows for us to do 2 more projects. And then if we end up having to sell both of those into 4 more projects, maybe we can hold on to 1 or 2 of those. So it's really, you know, we have to look at everybody, the company, the investors, and we tell people going into this, like the Verge, that's a merchant build. And I would tell you right now that if you want to place your money for 5 to 10 years, that's not our business model on this one. And we'll also tell you when we bring a project to you, and you'll know by the type of debt we get on and the way we underwrite it, this is one we want to hold for a while. This may be one where we wanted to recapitalize our development partner. Our development partner on this one did not want to do that. And it was their project, and we came in and we kind of had to work around their terms. So, but we're always looking to hold on to what we can. And I get it big time, especially at my age. I don't want to keep flipping these things and doing them over and over again. I'd like to have, you know, 5 of these cash flowing for the next 10 or 15 years.
Maybe the last question we can wrap up with is noting our experience with HUD Loans and how we kind of foresee that product working in the future. So
HUD Loans, for you guys, HUD Loans are loans that are underwritten by HUD or insured by HUD. And the attractive thing about them is that they're non-recourse, so you're not having to sign a personal guarantee on them. The interest rates are usually very favorable because the lenders know that the loan is insured, so they're going to get a little bit better rate because they've mitigated some of their risk. The amortization schedule on these, I mean, you could get, and you know, most everybody gets a 3, 5, or 7-year type loan, and sometimes a 10-year loan. Well, these are 40-year AM, 40-year terms. So that really is attractive on your cash flow. So it makes a lot of sense if you have the time and the patience to go through the HUD process, because it is about, you know, it could take a year to go through that loan process.
Especially now.
Yeah, even more so. Yeah. But boy, once you get one, and if it's a project you want to hold for cash flow, it makes a lot of sense to consider a HUD insured loan.
Yeah. Well, thank you, everyone. We really appreciate you joining us, and thank you so much for the questions. It's really great to answer some of these for you, and we're always available if you want to give us a call or shoot us an email if we didn't get to your question or if you've thought about something else. Please reach out to us. You can reach us at info@presarioventures.com. Our phone number 512-433-6325. Again, I'm Allyson Silver and Darin Davis.
Yes. Hey, guys, thank you very much for spending your evening with us. Hope to talk to you again. There's about 5 or 6 questions we didn't get to, and I'm absolutely available tomorrow if anybody wants to email or call. Good night.